Hey everyone, listen to what's happening this week in real estate. We're going to talk about fewer sellers, hesitant buyers that show a slower spring market, and also CMHC comes out with home prices will not revert to pre-pandemic levels, which I think they will and better. So listen in. What's happening this week in real estate with Conrad Zerini and Brian Hogbin, and we got some good stuff to talk to you about today. And CMHC came out with a report that is indicating what average sale price, what they're predicting, and I feel what they're saying is wrong. And I don't know, Conrad, Brian, what do you think?
Well, look, I agree. Like, how many times has CMHC been right? Absolutely. Like, it's yeah, not too many times. You got to give them, hey, God bless them for trying. What's interesting about CMHC, and Brian, you know these numbers a little bit better. There are some people that are underwater, right? That insured mortgages that are underwater. Probably, I think CMHC's got about 2.5 million worth. And Canada Guarantee's got about 4 million. So they kind of like to rattle everybody's cages around that. But other than that, like I just did, and you and I were just talking about earlier, Rob, you and I just saying about the market, right? The benchmark price is up. It's up 3.3 in Oakville, Milton. It's up 2.3 in Burlington. Hamilton is down slightly, 0.04. And Niagara is up 2.2. So the trough, that trough is done. We're on the other side of that. Yeah. And I'll give you another fun fact. I did from January, February, March, and April, I did properties that sold over list. 19% sold over list in January. We had somewhere like in the high 20s in February. We had 32 in March sold over list in all those areas. Okay. And 39 sold over list. 39% sold over list in April, year to date. So, guys, I don't know what these guys are talking about. I think that gap, the gap is going to get narrowed very quickly.
The ones that you were, I was just going to say, Con, the ones you're talking about that are underwater as well too. It's such a small portion of the market, yes. And it's the only people that are, and I know it's a kind of a crappy situation for them, but they're probably all first-time home buyers who put down anywhere from 5 to 7%. And if you put down 5 to 7%, your equity got eaten up again by a CMHC fee of 3 to 4%. So like if you put down 5%, technically as a first-time home buyer, you've only got 1% equity.
Yeah.
Right. Yeah. So it's like
surprise.
So, when you look behind the numbers and those people, they bought maybe at a high point, but they were also stress tested at a high point as well too. So it's like, those people can afford their homes. It is not great to be underwater, but you're underwater because of the CMHC fees as well too. And they're first-time home buyer. They're not speculators. Nobody else was buying those homes. So I think those people, for the most part, will be okay.
Yeah. You know what? This market, I just think that CMHC's got to get their act together when they give out these numbers. Like, I don't know. Like it's. They're adding a part of the last year that was an anomaly that will never. I mean, it will happen again, in my opinion, in 2027, first quarter 2000. That's what I predict. First quarter 2027, we're going to see prices hit a tipping point right there, and then in 2026 will be just like 2021 we just passed 2 years ago. I feel that's my prediction. So I want to, maybe I should keep this.
We got to write it down. Write it down.
I gotta keep this file. We got to get the newspaper and put it right there so we know that it's true that it. But anyway, like you said, I just did this just in Hamilton surrounding areas. I did the last 6 months of last year, average sale price. Actually, you know what? Let's forget that. The benchmark price last year, from June 1st to December 31st, was $725,000. Okay.
Yeah.
The benchmark price from January 1st till today is $740,000. So, like, we're up.
Yeah.
Like, I know, like, I eliminated the first half. That doesn't exist anymore. But we are on the climbing up again stage. And
Well, yeah.
so and I'll give you a perfect example. So people are still hanging on to those prices from last year.
Yep.
They're still hanging on. I went to a house in Stony Creek. Sorry, no, not Stony Creek, St. Catharines. The value of this house is $800,000, bang on, comparable show, everything. And I said to this guy, I go, listen, you list this at $800,000, you're going to get full price or more. No problem, full price or more. I go, you could try a higher number, but you're taking the risk. You are taking a risk. He goes, okay, sounds good. Yep, we're going to sign with you guys. Just give us a day or two. I just got to talk to his wife and everything. So on the way home, as I leave, he says, "Will you list at 829?" I'm like, I go, you could do whatever you want. I says, my advice is, if it doesn't sell at 829, we drop it at 800, and then you're going to get offers under 800, and you just lost money, and you could probably lose $10,000 to $20,000 because of that. And anyway, but that's that. So the other thing I want to talk about is there's a lack of homes on the market.
Yep.
And there was an article in the in the paper that they're saying demand is high, listings are scarce. The scramble for business is making some agents become very aggressive. Is that? I think that's true, eh?
Oh, 100%. Yeah.
That is true.
Yeah.
While the lack of listings is leading to some sellers to feel overconfident, that is true.
Yeah.
And sellers are not willing to part with their property at less than market value. So, well, depending what market value is, right? Like, I don't like. It is difficult, but I think people have finally entrenched and figured out what value is now, because they're starting to see houses in their neighborhood sell for what the market value is. They're not happy about it, but if they have to move, they understand it and they realize it. But other people aren't there. And there was one in that I went to, and every time you go to a client and you say, hey, what number do you have floating around? And like after you tell them what you think, right? But I always ask them that. Do you have a number that you got in mind that you're thinking about that your house is worth? Oh, no, I don't. Oh, okay, no problem. So as soon as you tell them, you know,
what?
We're telling them. So as soon as you tell them, oh, you know, your house is probably worth between 1.3 to 1.5 million, depending on, you know, doing some certain things. Oh, I thought it was 2 million. Well, did you just tell me you didn't have any idea? But you know what I mean? Like, it's funny though. No matter what, I always ask that question to see if they do have a number floating around. They always do.
Always do.
Oh,
well, you know,
always do.
And if you're a good agent, and I know your team members are like top notch, they know the stats. If you're really looking at the months of supply, right, you'll see that some people, you could push the envelope, because there's some areas in Hamilton where months of supply is dipping below 1 month supply. We have some that are 1.2, 1.3, 1.9, but some downtown central Hamilton, it's below 1. There's areas of Burlington below 1 month supply. So they can push the envelope a little bit and get their money, I think. And the other thing is too, there's a demographic that's really buying. It's the boomers. So they're out there buying. They're probably they just beat millennials in terms of buying. They're looking at it like this. If I get what I want, God bless me, I'm not afraid of the 20,000 spread. I found what I want. It's over with. And I did an interesting stat where I said in 30 years, from if you were 35 and you retire at 65 and you bought a house, if you bought at 35 and the house is 750,000, you'd have with 5%. So there's a 40-year number. It's 5.85%. I took off the 0.85% for taxes, maintenance, okay, and insurance. I took it off for that. I kept 5%, carried it all the way through. You would retire with $2.5 million, just under $2.5 million after 30 years. So, like, there's no question. Even these people that bought in 2022, God bless them, Q1 of 2022, over time, there's no issue with them. You know, they're maybe starting a little bit back further, but by the end, if you're 20, 30 years in your real estate ownership career, you're going to make up that money, no problem.
Well, look at the people that bought in the first quarter of 2017. They thought they overpaid.
Yeah.
But now those are good deals.
Cheap. It's cheap.
And how many years ago? It's not that many years ago. It is cheap. So things, you know what? I truly feel that with the transfer of wealth that's going down to Generation X, right?
Yep.
The amount of immigrants coming into this country, like we were just talking, there was a million that just came in. Is that right, Conrad?
Yeah, a million, over
a
a million
in the past 12 months.
In the past 12 months, a million. And the startups for new builds are not there. They're
down
way
about
down.
15%. Single families down about 16% across Canada.
Yeah. So I truly feel for the next 20 years, I think real estate values are gonna be outperform what the last 20 years did in the next 20 years. I know. And I like the way you were telling me, like that one stock that Blackstone.
Yeah, Blackstone.
16.5% from 1990.
1991,
I'm gonna look into that stock.
Yeah, it's amazing. Yeah.
They've outperformed everything. So hey, Conrad, you should start an investment fund. Like, you've got the connections and you've got the power to do it.
Let's do it.
That's a good idea.
Let's just buy real estate. Let's start up a fund.
We just got to copy Blackstone. That's all. Whatever they do, we'll do in Canada.
We just copy them. That's it. That's it. Just copy Blackstone, and everybody have a 16. You know what? That 16% thing is even better than owning anything else you can, because that's a great return.
So this latest fund, and I was telling you, this latest fund is in like data centers, like industrial data centers, hospitality, and rental housing. So those are the three pillars, right? So those are really high value. That's what's really doing well in real estate right now. And now they own 2%. They own 0.2% of all the single family homes in the U.S. And there's 95 million homes, single family homes in the U.S. So you do the math on that. It's about 2 million.
No shit. No kidding. Oh my God. Now they're buying up in Canada now, aren't they?
Yeah, they're buying up in Canada. Yeah. Now they did. Yeah. Go ahead.
But I think they did end up buying some high-priced homes. They were buying during the market was high, but they know overall average in the long term, their return is going to be greater, because they've been through a bunch of different markets. Now, like they bought since 1991, you said, right? So
they have 360 some odd million under assets under management right now. Yeah, 360 billion with a B. Right, that's pretty significant. And you know what? They got a little flack because there was some media when they came to Canada and they opened up an office in Toronto. There was some flack about them buying single families.
Yes.
Everybody got a little bit all, Canadians, they get all crazy.
Yeah. No kidding.
When somebody has a good idea.
People were worried about there was going to be a shortage of homes. Well, we have a shortage of homes. Yes. Will they make an impact? They're going to make a tiny dent, not enough to really anybody to see. But I'll tell you, that's anything to do with the real estate is the way to go. Like now, quick before we got a couple of minutes, Brian. How are people? What's deals coming in like crazy, or what? Things have picked up quite a bit.
Yeah, we're getting it's funny because we're going back to the cash offer questions again. So a lot of that price point, anywhere between 6 and 8, 6 and 9. We're seeing competitive offers. We're seeing people want to go in cash. They're calling us to firm up before they're going in the offer. So they want to know everything we can have there. And everybody's off the fence now. The other thing we're seeing a lot of now too is the conversation about breaking the mortgage is getting less, because a lot of people, they're maturing and now they only have 12 months left, 18 months left, 6 months left. So a lot of them are thinking, you know what, maybe this is a good time to sell so I can get top dollar and then do the move up. And they're taking that, even if they have a $10,000 penalty and then they've got to pay a little bit higher rate, because the spread now between what they had at 2.5 and a 5-year is not that bad anymore. It's still an increase, but I think we talked about this before, just because your interest rate doubles, if it went from 2.5 to 5 or 2 to 4, your payment doesn't double. That math does not equate.
Right.
You know what I mean? A lot of people think, oh, my interest rate doubles, so my payment's going to double. No, there's way more complicated math at work there. Yeah. So I think we're seeing a lot of those people beginning to realize, hey, okay, I don't like my house anymore. I'm not tied to my rate anymore. I'm ready to move up. So I think that'll start to push more supply on the market as spring rolls out and summer rolls out too.
What's the 5-year rate right now? If somebody wanted a mortgage 5-year rate, is it 5 or 4.5?
So it depends. 20% down, you can get almost. I think the last one I saw was 4.89, really good with a bank. And then if you put down less than 20%, because you can get a better deal on insured, you're almost at 4.39 right now on a 5.
So question in the long run, at 4.39 with less money down, does it work out in the 5-year period? Does it work out better, or does it work out better with the 20% down? Like what you've paid in and interest. Like if you actually worked it out, like, I mean, obviously less money down.
It works better.
Equity.
It works better. In my opinion, I'd go the 20% down if you can, because like the 25-year, you're paying the CMHC surcharge on top of it too. So you have to pay a premium on top of it, right? And then your cash flow is not as good because it's only a 25-year AM, so your payment's bigger. So I just like the flexibility of it too. If you put down 20%, you're saving money. You've got a lot of options there. So that little spread in rate, we don't typically recommend to put down less.
The small commercial investor buys 10-unit, 4-unit, or even a small investment like 3 units upstairs and a commercial on the main floor. What is the interest rate for small commercial guy?
Well, unless you're a big one like Conrad doing like, big units, you know what I mean? Like those rates are crazy good, actually. Like through CMHC insured, you can get really good rates there. Like they're dying to give that money away cheap. But the mixed use one, you're looking at probably anywhere from the 5 to the 7. They're a little bit higher than your residential rates.
It adds up fast. Yeah, no kidding.
Yeah. I know we got quick for time, but I'll tell you something. When you take the 20% down at the, and I just did the other day, a 1-bedroom condo in Hamilton, Burlington. If you take the 20% down, and your payment is almost lines up with what rental rates are, and then when you factor in $600 a month of equity, right, that you're at 4.5, it's substantial, right? You know what I'm saying? So we're almost there. Like 20% down, we're equal to rental rates. So that's another reason why 20% down is really good.
Good stuff. Yeah. Good stuff. Well, guys, thanks a lot. I appreciate your time, and have a great weekend, and we'll see you next week.
Great. Thanks.
Good stuff.